The S&P 500 cleared 7,800 for the first time ever last week, then pulled back as Iran tensions escalated and oil rose back to $91. All-time highs feel like dangerous places to invest. The natural human reaction is, prices are at their highest ever. Surely now is the worst time to buy. This feeling is almost always wrong, and today I want to explain exactly why using data from every previous all-time high in market history, the data on investing at all-time highs, research across decades of market history shows that investing at all-time highs produces returns that are roughly similar to investing at any other point, and in many cases slightly better. This seems counterintuitive until you understand the mechanism. Markets set new all-time highs most frequently when the underlying economy and corporate earnings are strongest. Strong earnings and strong economy are also the conditions that tend to produce continued positive returns. All-time highs cluster during the strongest periods of economic and earnings growth, which are also the periods of strongest forward returns. The S&P 500 at 7,800 in context. The S&P 500 was at approximately 4,800 at the start of 2024. It is at 7,800. Now, a 62% gain in roughly 2.5 years. If you invested at the start of 2024 and held through every Iran conflict, every Fed rate decision, every tech sell-off, every recession fear, and every geopolitical shock, you are sitting on a 62% return. If you waited for certainty before investing, you missed it. Investors are increasingly distinguishing between companies directly benefiting from AI, infrastructure spending, and technology businesses, where the financial payoff remains less certain. STL. This is the market maturing. In the early AI excitement phase, all AI-adjacent stocks rose together. In the maturity phase, winners are separated from losers based on actual earnings proof. This is healthy. It means the market is doing its job of allocating capital to the most productive uses. It also means index fund investors participate in the winners automatically while being cushioned from the losers by diversification. The most important thing to remember at all-time highs: time in the market has always beaten timing the market. Every all-time high in history was eventually followed by an even higher all-time high. Every correction from an all-time high was eventually recovered. The S&P 500 at 7,800 will one day be the low point that people wish they had bought.